I've prepared a video with the 3 best beginner trading strategies that work for all the time frames and for all the markets. So welcome back and thank you for the great feedback on my last videos. It is really great to see all the positive feedback. If you want to make sure that I keep making regular videos, leave a comment below the video, leave a like, and most importantly, make sure to subscribe to my YouTube channel. And now let's get into the 3 strategies. So the first one is the breakout build-up. I've talked about this previously and it is one of my most favorite setups and one of my bread and butter trading strategies that we also trade in the masterclass. You can check a link to the masterclass in the description below. We have a super special offer where you get all of my courses, which are currently 8 trading courses, hundreds of hours of videos. It's for beginners as much as for advanced traders. And you will learn dozens of trading strategies that you can apply to all the markets. And the breakout build-up is really, really powerful. It helps you to find new trends very early on. So here, we use a 50-period moving average. You can see the market was below the moving average, which means that the price is in a downtrend. And we are looking for turning opportunities. So we look for when is the market going from a downtrend to an uptrend. And this happened around here. First of all, the market just barely made a breakout into a new low. So a very, very weak breakout. If you put an RSI, for example, here, you will see that there is a divergence, which is already an important signal. And you can see at the same time we are establishing here a resistance level. So resistance and second resistance. And then before the breakout, the market pushes back into the level, but it doesn't automatically or immediately break it. There's a small bearish candle, but this candle is really small, so the market and the sellers are not able to push the price lower, which is important because after such a move, you would expect the market to either break out or the sellers come back in as they did here before and push the price down. But it didn't happen. Just a small bearish candle with a strong wick, which indicates that there's actually a lot of buying interest. It's just not the right time yet. And then the next candle is the final signal. The next candle is the build-up or is the breakout. This is the build-up, this is the breakout. A very, very strong candle completely engulfs the previous bearish candle. Also, there's no wick on this candle at all, so it shows that it's a very, very strong bullish signal that you have here with this huge bullish candle. And then you can see the market just rallied and rallied. So a perfect signal and a perfect way to get into a new trend early on. You don't want to pick the absolute bottom or the absolute top. That's what the amateurs do. But you want to wait for real signals, real confirmation that the market is really turning. Let's take a look at another breakout build-up. This time we're using RSI divergence, and as I said in the past, in the previous slide, in the previous example, very, very often you will see the breakout build-up and those turning points come with the divergence. So here the market was above the moving average, it was in an uptrend, higher highs and higher lows, until here something has changed. Although the market is still making a higher high, now it comes with a divergence, which means that the price action is not that strong actually, and the push here into the new high is much weaker than what we have seen here previously. So that's already important heads up. And you can see we have a previous swing low here during the trend. The market comes back into the previous swing low, but it fails to pull away. It's not even coming close to the previous swing high. And whenever something like that happens, when you are in an uptrend, you are in an established trend, and then the market fails to reach the previous high point or in a downtrend the previous low, that's really where you should start noticing and you start be very, very observant about price action, because that tells you that from here to here, the buyers almost completely withdrew. There's not a lot of buying interest anymore. And then it's just a matter of waiting. You wait for a confirmed breakout. And you can see the market is not able to pull away at all from the level, which is our build-up. And then here you have your strong bearish breakout. And it's very important that you have a strong breakout. Just like in the last example, here you have a very, very strong bullish breakout. Now you have a very, very strong bearish breakout. And you can see the market pulls back into the breakout level, gives you here a retest to fish for those break-even stops. And then the market continues or starts the new downtrend that was initiated here on the breakout. So it's very, very interesting to follow those transitions and looking at those highs and lows and how how they shape, how much distance is between a high and low, do you have a divergence. That can tell you a lot about price action. The last breakout buildup before we move on to the second strategy is here we have, or the market was in an uptrend all the way above the moving average. Then here it failed to break higher, although the market tried to close above the high, and it did for a brief period of time. The market immediately collapsed and it fell back into the range, which is already a bearish signal. It's not enough to sell yet, but it's already a bearish signal. Then here you can see the market is not coming close to the previous high. The price pushes into the support level that had been established in the meantime. So we have one support level here touch. Here we have a close on the level, and here we have 2 or 3 closes on the level. So very clear support level. And then here on the last swing point, the market is not even coming close to the previous high. Here was the lower high compared to the top. And then here, significantly lower high, below the moving average. So a lot of selling pressure is building up. And then here you have your breakout, and you have your retest, and then you have your collapse. So this is really where the new downtrend is started. Don't sell as long as the market is still trapped in this range market, in the pattern, but wait for the market to break out, and then you can either trade the breakout or the pullback, which is what we do in our masterclass with a few different approaches. Second approach is the Fibonacci extension, which I'm a huge fan of. I've made various videos about Fibonacci extensions, and it all starts with a shift in the trend dynamic as well. So we want to look for an established trend that looks like it's going to reverse. And whenever the market cannot make a higher high, like in this case, the market always made a higher high, a clear uptrend, here you have a lower high. So we can drag our Fibonacci from point A, which is the origin, to point B, which is the end of the first downtrending wave. And then you can see here is our point C, which is the 38.2. Very, very nice rejection of the 38.2. And then once the market breaks the 100, it goes on to make the 138, it goes on to make the 161, and even all the way to the 200th bonus round. So if you can see such an A, B, C pattern, the Fibonacci extensions help you to pinpoint your exit and your target. You can even use the Fibonacci's on your breakout buildup. You can, for example, you could put your Fibonacci from A to B to C here, or you could use from A to B to C here, and then use one of the Fibonacci extensions as your target here. Another example, in a new existing uptrend, so the market was in a downtrend, then the downtrend is turning around, we have our first higher low, and once we have our first higher low, then we drag our Fibonacci from point A, is the bottom, to point B, which is the end of the first new trend wave, and then we look for where's the point C snapping. So here we have 38.2, very, very nice rejection of the 38.2, and then you can see first the market clears 100, it easily makes its way to the 138, then 161, and all the way to the bonus round of the 200. So 138, 161 are very common to see if you have a completed Fibonacci extension, whereas the 200 is usually quite a bit away, so you will not often get a 200 Fibonacci extension move. Here we have another final example of the Fibonacci before we move on to beginner strategy number 3. And here we have our first new trend wave. So here the market was moving down, lower lows and lower highs until here. So here was then the first higher low, and that's when we start to drag our Fibonacci onto the chart. So we use point A is the low, point B is the end point of the first trend wave, and then we wait for the market to confirm one of those swing points. So here we have the 61.8, and the market goes on to 138 and comes shy just a little bit of 161. So sometimes it doesn't go even all the way to 161. Sometimes it doesn't clear the level. So you have to play around with targets and how aggressive do you want to be. But Fibonacci extensions can be applied to many, many different trading strategies as a way to help you be more objective on targets and help you find the right targets. Fibonacci's are very widely used also among the big players. Also many algos use Fibonacci's because they are very easy to program, they're very objective, and they provide good target opportunities and target helps. Here we have our third strategy, which is the fake out, and I talked about the fake out before in my previous videos quite a bit because I think it's one of the best strategies, and you want to look for an established trend. So here you can see the market is in an uptrend until this point here. Then you wait for the market to come back to a previous swing high. So once you have established a swing high, you can just draw your level on it. You can put your price alert on it in TradingView, for example, and then you wait for the price alert to go off. And what you want to see is the market go beyond the previous swing high, but not close above it. You want to have a strong rejection of the level, which then makes it look like a fake out. And this pin bar is not enough to trade the fake out. I would always recommend to wait for the next candle, because as we've seen in the beginning of the breakout buildup, sometimes even you have a potential fake out with a pin bar, the market may still continue higher on the next candle. But if the next candle is another bearish candle further away from the fake out area, that is another important piece to the puzzle, and it shows that it looks like the bears are really taking over here. The market did roll over here with a rejection, the tweezer here, and now with a pin bar. So we have a strong bullish candle, fake out bullish candle, and then a strong bearish candle. And this is a 3-candle reversal that is very, very common and very powerful. We have another fake out here. So whenever you have a swing high or a swing low, I would draw it on your charts. Just put a line on the swing high, and then you can see when is the price coming back. You can see the market almost came back here, didn't quite make it, but also didn't really sell off. So here it looks like the market is making another run at the level. The wick here completely sticks out above the previous highs, but never closes above it. But it's a very strong bullish close, so I would not trade a bullish, or I would not trade either a bull or a bear trade on this bullish candle, because it doesn't really confirm the breakout, and it doesn't also confirm really the rejection. It's still very close to the previous highs. So we wait for the next bearish candle, which is super strong. So a very strong bearish candle closing all the way at the bottom, which is a very, very strong selling signal, or a very strong bearish signal at least. And this is really what you want. You want to have a sequence of candles at the right context. So strong bullish candles, potential fake out goes to then a strong bearish candle. And here we have our last fake out. The market is in a downtrend, and then here was the last swing low. The market was not able to push lower after this bearish candle, and this is a huge bearish candle, right? So what would you expect after such a big bearish candle? Many traders would expect a continuation, but if there's no continuation, and you can see afterwards we have probably a dozen candles or more to wait, and never did the market make a lower low, and never made the market a lower close. Quite the contrary. Here you have a fake out. You have a candle that looks like it's trying to break out, but it's immediately rejected, closes back into the range. And then what I would do is I draw here a trend line on this price pattern. So you have some type of triangle here probably if you connect the highs. And then you just simply wait for the breakout of the triangle. And this happened here with a strong bearish bullish candle that is completely breaking out of the previous range. So again, just because you have a fake out candle, it's not enough to get you into trades. I would always encourage you to wait for an actual breakout, or to wait for more confluence. And that is what you have once you have a breakout, or as in the previous examples, when you have a 3-candle reversal pattern. And then you can make much better decisions. So those are my 3 beginner strategies. I hope you enjoyed them. I hope there's something for you to take away. Let me know which one you like best. The first, which is the breakout build-up, the second one, which is a Fibonacci extension, or the third fake out. Let me know in the comments below, 1, 2, or 3. And I look forward to hearing from you.